Last week, the credit rating agency Fitch, they downgraded the United States long-term credit rating. We were AAA, now we're AA+. Well, what does that mean? What it means is that it's going to cost more money to service our $34 trillion in federal debt. The response that Janet Yellen had was that it was completely unwarranted. But wait a minute, stop. Unwarranted? What's her basis for this? Well, she really doesn't have any, because the reason that it was downgraded is because our federal deficit is equal to 125% of our country's gross domestic product, depending on how you measure it. There's debates on all this stuff. But if you and I were at 125% debt to income ratio, would you qualify for a home loan? Could you even buy a car today? I say that you couldn't. I was a loan officer for 15 years, and I went through this every single day as I was underwriting loans and getting people approved. Now, as a direct result of this, Moody's, another credit rating agency, came out and downgraded the credit rating of 10 major banks. And the reason that they cited this is because of the Fed raising interest rates. We're at a 22-year high right now, and we went from historical lows, and this has happened in less than a year. It has really wrecked the balance sheet of most major banks, and the cost of doing business is higher, competition for deposits is higher. It's just created huge problems in the banking system. So when you look at a balance sheet of the bank, you can see right here, it's a great graphic of it. You have your liabilities and you have your asset. And you look under the liabilities, and you have your deposits, long-term deposits, and so on and so forth. On the liability side, we'll look at this. You have treasuries. These treasuries today are worth about 50 cents on the dollar because interest rates have doubled, causing treasuries values to fall. It's an inverse relationship. Then you look at the commercial loan portfolio. Well, there's some $300 billion in commercial loans that need to refinance here in the next 24 months. And many of them are at 3 and 4%. Well, are they going to qualify for the new 7% rates that are available? And you go through and you look at the asset side of this balance sheet, and you can see how the increase in the federal funds rate has really wrecked the assets of most banks. So this is my market update. I give it to you like it is. It's real. It's happening right now. I'm not sure what the future holds. I do think that interest rates are going to have to come down for a number of different reasons. So I hope you find this information useful. Please share it with your friends. Give me some comments, and I'll catch you on the next video. Thanks.